Let me ask you something. Have you watched the news and heard words like bull market, recession, interest rates, and just felt completely lost and left behind? 2025 was one of the most confusing years the markets have had in a long time. Experts were saying completely opposite things. Some were screaming that a crash was coming, others were saying, no, keep buying. And somehow, both sides had data to back them up. Jobs stayed strong. People kept spending money like it was growing on trees. And if you bet against Nvidia, one of the biggest AI companies in the world, you lost. Badly. But at the same time, a lot of smart people were looking at the numbers and saying, something doesn't add up here. This can't last forever. And now we're in 2026, and it's getting even messier. So today, I'm going to break down exactly what happened, why it happened, what the different possible outcomes look like going forward, and what it could mean for you, even if you've never invested a single dollar in your life. Before we get into it, let me quickly set the stage, because you can't understand where the markets are going if you don't understand where they've been. Think of the stock market like a giant scoreboard. It tracks how confident people are in the economy. When people feel good, when jobs are plentiful, businesses are growing, and money is flowing, the scoreboard goes up. When people get scared, it drops. In 2025, here's what was happening on that scoreboard. People with jobs did well. Employment rate was fairly good. People kept spending money. And one sector, artificial intelligence or AI, was absolutely dominating the conversation. But here's the catch. Not everyone was convinced all of this excitement was real. Some people looked at the numbers and said, wait, this doesn't add up. We're heading for trouble. And that tension, that tug of war, is exactly what made 2025 so confusing. And it's exactly why 2026 feels so uncertain. So here's what we're going to do today. I'm going to walk you through three possible scenarios for 2026. The pessimistic case, the optimistic case, and the one scenario that nobody seems to be talking about, but might actually be the most likely, the pessimistic case. What if things go wrong? All right, let's start with the scenario that most people are nervous about. And to understand it, we need to talk about something called valuations. Here's the simplest way to think about it. A valuation is basically the price tag on a company compared to how much money that company is actually making. Imagine you're at a garage sale. Someone is selling a lemonade stand. It makes $50 a month, and the person is asking $3,000 for it. That's expensive. That's a high valuation. You're paying a lot for not a lot of actual earnings. Now apply that to the stock market right now. One of the biggest AI companies, Nvidia, is trading at around 47 times its earnings. That means you're paying $47 for every single dollar that company makes. Other AI companies, we're talking 400 times earnings. At that point, you're not really investing based on how much money the company is making. You're investing based on hope. Hope that AI is going to be massive, and hope is a risky thing to build a portfolio on. And here's why that matters beyond just AI stocks. These AI companies are so big, so valuable, that they're basically dragging the entire market up with them. When Nvidia goes up, the whole tech sector goes up. When the tech sector goes up, the S&P 500, which is basically the scoreboard for the top 500 companies in America, goes up too. So the S&P 500 looks great on paper right now. It's been on a run. But a lot of that success is coming from just a handful of companies. In fact, 7 companies, often called the Magnificent Seven, account for over a third of the entire S&P 500's value. And through 2025, those same 7 companies were responsible for over 40% of the index's total gains. Think of it like a relay race where one person is doing all the running. Everything looks like it's moving fast. But if that one runner trips, the whole team stumbles. And there's one more thing feeding this problem. Most regular investors don't pick individual stocks. They buy index funds, which are basically baskets that hold a bunch of stocks at once. The problem? These index funds give more weight to bigger companies. So every time someone puts money into an index fund, a disproportionate amount of that money flows right back into those same few giant tech stocks. It's a cycle, and cycles are stable until they aren't. Historically, the market tends to pull back at least 10% roughly once every 3 years. That's not a crash. That's normal. It's the market catching its breath. And after a stretch of big gains like we've had, history suggests we might be due for exactly that. But here's the uncomfortable part of this scenario. Even if everything I just said is true, even if valuations are stretched and the market is top heavy, that doesn't mean it's going to correct right away. Markets can stay irrational longer than most people expect. Being right about the risk doesn't mean you're right about the timing. The optimistic case. What if things keep going up? Okay, now let's flip the script. What if the market doesn't crash? What if it actually keeps climbing? For this to happen, we need to understand two things: interest rates and government spending. Let's start with interest rates. Here's the simple version. When the government, specifically the Federal Reserve, which controls interest rates in the US, lowers rates, it becomes cheaper to borrow money. And when it's cheaper to borrow money, people and companies spend more. They take loans, they invest, they start businesses. At the end of 2025, the Federal Reserve cut interest rates 3 times. Each cut was small, 0.25%. But the direction matters more than the size, because cuts signal that the Fed thinks the economy can handle looser conditions. And going into 2026, expectations are for at least one more cut. What does that mean for the stock market? More money flowing into the system, more people willing to take risks, and when people are willing to take risks, stock prices tend to go up. Now let's talk about the second tailwind: government spending. The US government is currently spending way more than it's bringing in. Over $1 trillion more per year, actually. That's called a deficit. Now, long term, that's a problem we'll save for another day. But short term, here's what government spending does: it pumps money into the economy. It keeps people employed. It keeps businesses profitable. It keeps the wheels turning. And government programs don't get shut off overnight. They take months, sometimes years, to wind down. So even if the economy starts to slow, that safety net is still there. So if you put those two things together, lower interest rates and continued government spending, you can see how the optimistic case actually has some real foundations. It's not just wishful thinking. There are actual forces pushing the market higher. The gray zone. What nobody's talking about. And now, here's where it gets interesting, because most people are arguing about one of two things. Is the market going to crash, or is it going to keep rising? But there's a third option, and honestly, it might be the most likely one. What if 2026 is neither a great year nor a terrible year? What if the market just goes sideways? Picture this. The market goes up for a few weeks. People get excited, then it pulls back. People get nervous, then it goes up again, then it pulls back again. No real crash, no big rally, just constant back and forth, like a tug of war that never ends. This is called a sideways market. And here's why it's actually harder to deal with than a crash. When the market crashes, it's dramatic, it's obvious. People know something is wrong and they act on it. But a sideways market, it messes with your head. Every small dip feels like the beginning of a crash. Every small rally feels like the start of something big. And if you react emotionally to every move, buying when it's up, selling when it's down, you can actually lose money even in a market that isn't going anywhere. Think of it like waiting for a bus that's 5 minutes late, then 10, then 15. At some point, you don't know if it's coming at all. And that uncertainty, that's what eats people alive. This scenario makes sense because right now, you've got powerful forces pulling in opposite directions. Rate cuts and government spending are pushing the market up, but stretched valuations in a top-heavy index are creating downward pressure. When those forces are roughly equal, markets don't go anywhere. They just chop. So, here's where we stand. 2026 could go in a lot of directions. It could be the year the AI bubble finally pops and drags a top heavy market down with it. Or it could be the year that lower interest rates and government spending push everything higher than anyone expected. Or, and this might be the most realistic option, it could be a long, messy, choppy year where nobody really wins. And the biggest risk isn't the market itself, it's your own emotions. And here's the thing that I think is actually the most important takeaway from all of this: nobody, not the experts, not the analysts, not the people with the fanciest charts, actually knows for certain what's going to happen. Anyone who tells you they do is either guessing or trying to sell you something. What you can do is exactly what you just did right now: learn, understand the forces at play, and make informed decisions based on your own situation, not based on fear and not based on hype. If this video helped you understand even a little bit more about what's happening in the markets right now, do me a favor. Hit that like button, subscribe if you haven't already, and drop a comment below. I want to know, do you think 2026 is the year things break? The year we rally even higher? Or do you think we're headed into that messy gray zone? Let's hear it in the comments. Take care, and I'll see you in the next one.